All right, I want to get your thoughts on the markets, especially on a day like today where the low for the Dow was down 236 and we're now positive by more than 100 points. What do you see as the major themes or major factors that are driving this market right now, and how is it shaping your investment thesis?
Sure. I think when I had originally got asked to come on the show, I had said the equity markets and credit markets seem to be telling two different stories. At least as of yesterday, it looks a little bit like maybe the equity markets are getting on the same page. But what's interesting is why the market actually is as strong as it is, given where the economy is where it is. Essentially, if you think about where the levels are, I realize that they project out into the equity markets project out into the future, but are we saying that the world is as good now as it was in February? I don't know. The data that's emerging on that is kind of mixed, so only time will tell. But I think we're in definitely a dislocation, certainly between Main Street and the markets.
One of the things that got my attention just looking at your notes here is that you're watching inflation or the possibility of surprise inflation very closely right now. How do you see it? And how is that shaping the decisions you're making in terms of investing opportunities right now?
Yes, I've spent quite a bit of time looking at inflation. I spent the last year actually looking at it and then had to kind of redo all of my analysis when COVID hit. But one of the largest inputs into any asset allocation framework is your expectations about future inflation. And I think one of the difficulties for us is that if you look back to the 20s, there's few periods of inflationary environments really to draw a lot of conclusions from, because the drivers in each of those environments were different. So I don't know whether inflation's on the horizon or not, but I definitely think it's a risk that we need to be aware of, especially because in those types of environments, the correlation between stocks and bonds tends to be positive. As you know, and people have said on your show many times, we all think of the negative or low correlation, but that's really a recent phenomenon. So what is that? We're not a risk parity portfolio, but what does that mean for diversification from the largest risk in our portfolio, growth risk, if inflation does occur? But in general, all long-only assets, they suffer in those type of periods. So the returns to market betas will be lower, which obviously affects our ability to hit our return target, which at ERS is 7%.
Yeah, well, I was going to ask you about that, Elizabeth. This David Faber, that 7% number. I mean, right now you're dealing with rates that are rock bottom. Obviously, there is not a sign of inflation, at least to the extent that there's any move on the Fed's part to even think about raising them, which would seem to indicate you've got to stay largely in stocks if you're going to generate anywhere near that return you just stated.
Right, David, you're 100% right. I think long term, you always have to be invested in the market and the equity market. If you want to achieve your return over the long run, the only thing that historically has indicated they can really do that are the equity markets. Although depending on where inflation shapes out, you may be able to tilt your portfolio one way or the other. So, the last couple decade winners, quality growth, going forward, equity markets, maybe value and small cap. I think there's still time to tell on that. But I think that there are two different kind of scenarios if you move into an inflationary regime, especially a surprise inflationary regime. And some of the things that work when inflation is on the rise don't work as well on deflation. So you have to be very careful about how you allocate your portfolio. So at the margins, maybe you make some adjustments, and it doesn't have to be all real assets or tips, although linkers and obviously inflation sensitive assets additions to the portfolio would obviously be a great idea.